Hi, David Moore, Equity Advantage with Robert Smith, the Peregrine Private Capital. And then this is our last little segment of the day. And I wanted to talk a little bit about debt relief. And I guess debt relief can sort of come at us a variety of directions. Debt relief can trigger taxation on a disposition. A lot of times people think about 1031s and they think, well, gee, I've got to go out, and they've been told forever they got to replace debt, which you don't have to do. Debt can go away two ways. One, by going down value, triggers tax because you went down in value. The other way debt's going to go away is by adding cash to a purchase, which is something that obviously, that dreaded R word again, recessionary times, typically we're going to see a reduction in loan to value. And we're probably going to see a reduction in equity there, and it's inevitable that the taxpayer is going to have to come out of pocket some money to offset that reduction in debt. Just so, once again, we're going to be adding cash to the transaction, which reduces the debt on the property but gets people made whole. So when we're looking at the product that you deal with day in, day out, this is probably a conversation and by the way, like I said, debt relief, if you sell and you want to, maybe you don't want anything, right? Maybe you don't want to buy a DST. Maybe you don't want to do an exchange. I mean, you might just say, hey, today I'm going to sell. I'm going to take my money and sit on it for a bit. And, recessionary times, those with the gold make the rules. So maybe if you got the ability to do this, great. But the reason I bring up that debt relief in an installment sale, for example, somebody might sell and say, well, gee, I don't want to buy anything. I just want a check in the mail. And one of the ways to get a check in the mail is an installment sale, which is another presentation, another topic. Actually go back and watch the one I did last week. But if we're talking about people balancing their equity, that debt relief can trigger a problem on dispositions on installment sale, because if people a lot of times think, well, if I'm not getting the money on installment sale, if I don't get a principal payment at close, I'm not going to have tax exposure. Well, if you've got a property that you sold and it's got debt on it, and you carry a paper on it, no trustee to land sale, you're going to have tax on debt relief in that situation. So it's important that you talk to your tax people anytime you're contemplating seller finance or anything there. But debt relief, for the context of today's presentation, I just want to talk briefly about your ability to accommodate somebody. And you've got a variety of not topics, but a variety of product out there that you can sort of blend in to get somebody where they want to go. So first off, I just want to say debt goes away two ways. One, by going down. The other way is by adding cash. So adding cash is always fine. So if we go to Mr. Smith and say, hey, I've got a property that I just sold that was 70% loan to value, how do I get there? Is it possible to do that through some DSTs?
It's not only possible, but it's easily done, because the majority of DST properties come to market prepackaged with debt. It is indeed a turnkey program. You don't have to go out and qualify for the debt. That's done by by the property sponsor, who is a signatory trustee on the loan, because institutional providers can usually borrow money more cheaply than we can, and it just makes everything easier from an investment standpoint. And because of that, then there are varying levels of debt on DST properties. They can be as low as, a small number of DST properties are all cash. There is no debt. And loan-to-value ratio on DST properties with zero coupon DST properties can go as high as 83%. So, and the nature of the DST format is fractional ownership of a much larger piece of real estate. So you can pretty much slice it and dice it any way you want, and you can mix and match any number of DST properties with different loan-to-value ratios to arrive at your target LTV replacement requirement from an exchange standpoint. So it's easily done.
So for somebody, let's say I came into an exchange, maybe I sold $1 million property, $500,000 in equity. How often will somebody come to you and say, okay, I've got $500,000 to work with? How often will they just buy one DST? Will they diversify into multiple? And the diversification, once again, is based upon probably a variety of decisions.
I think, everyone, given their druthers, David, everyone wants to keep the exchange process as simple as possible. That being said, most investors are savvy enough to realize that from a pricing standpoint, we're still, even after a year of rate hikes, we're still at historically high levels of pricing in terms of commercial real estate. So most people want to diversify, and that's one of the questions to ask: how easily can I diversify with a DST? Well, that is at this point in the real estate, late stage real estate pricing cycle, that's the biggest advantage of DST is the ability to slice it and dice it, mix and match. You can diversify functionally, you can diversify geographically. So people want to keep it simple, but at the same time, they now realize the importance of diversification in terms of, hey, we're probably at a point in time where it's not so much how much more money can I make on my money, but how can I best hold on to the money that I have in terms of hedging against potential downturn in prices. So,
well, my buddy Jim, a couple months ago, when he was talking to you, what was his interest? It was purely preservation, right? I mean, he didn't care at all about it going up. He just wanted, when it goes full cycle, to get his money back. It's what he wanted to make sure was going to happen.
Smart guy.
Yeah. So right now, obviously we've talked about, we're not going to talk about numbers today, but the return on investment's lower today than it had been just because of the world that we're in. So if somebody's offering you some real high return, that's going to mean that there's some risks involved. And back to my buddy Jim's comment, he just wants the money there. That preservation of capital and wealth, he didn't have to worry about it. So obviously unencumbered property is going to reduce that some too, and the higher LTV you got, the more potential issues you're going to have there. Right. The other thing I just want to mention is one of the big things during recessionary times too is you might, no matter how well you do financially, you might have a hard time getting financing in some of these things. You might have given up a property and it takes a while to get the financing. Who knows what that rate's ultimately going to be. So if I come to you and I know the answer to this, but just for those out there, if I come to you to go buy something, what do I have to do to get the loan on that property if there is a loan on it? I mean,
nothing. It's all right. That's a really good point that you brought up, David, in terms of, unfortunately, in a rising interest rate environment like we're in now, the uncertainty of the lending process from a time and rate standpoint. That's because, bankers aren't dumb. And they know if the Fed's going to raise interest rates 2 more times, 1/4 of a point, all other things being equal, they're going to wait longer to make that loan, because if they wait another 4 weeks, they can charge another 1/4 point for it, okay? And so what that's done is that has greatly elongated the lending cycle, or being able to secure lending on properties, even at the institutional level. So if it's hard at the institutional level and it's extended out that time frame there, it's got to be even harder at the retail level for mom and pops. So it's a very good point on your part that the majority of DST programs do come pre-packaged with loan, and so that's not something you need worry about in an environment where it's becoming increasingly difficult and expensive to encumber a property. So very good point.
So one other thing, thank you. One other thing I want to sort of stress too is we're in a situation where maybe back to the loan process, the time to get things going, we might have somebody that's concerned about not having their money working. So one of the things I don't sell DSTs. I don't get anything if somebody buys a DST. I just deal with them every day, so I don't have any agenda here. But I guess the other thing I'd like to mention, and we had some issues during the last recession, that if you've got some of the institutional TIC offerings, the loans are each owner has to go out and qualify for it and get it done, and that most of the time the sponsor's tying up the asset, filling the bucket with investors, and then closing on it. So in the DST space, the offerings are all packaged and all owned. And so if I come to you and say, Bob, I've got, once again, back to my $1.5 million, and I need the income, I need my money working ASAP, how long from the moment I engage you to a mailbox money for me?
Well, that's another great question, Mr. Moore. I won't say it's almost instantaneous, but because the properties are already encumbered with a loan, and by law they have to be fully stabilized, meaning they're out of the ground, they're tenanted, and they're cash flowing. So the majority of time is going to be spent in you selecting your property or properties. Once you selected that property and completed the paperwork for it, it's probably going to take not more than 5 business days to close and begin cash flowing on invested equity. So if you're concerned about your money remaining offline for an extended period of time, due to the pre-packaged turnkey nature of DST properties, as soon as you decide on your property and complete the paperwork, you will likely be closed within 4 or 5 business days, and that's where cash flow starts. So it minimizes downtime on your money from cash flow standpoint.
And by the way, you don't have to wait until we have closed your relinquished property to do this. I mean, you can have it set up where we can basically, we could wire funds from the relinquished property closing straight into the purchase if we needed to. So there's no reason, if you've got earnest money down on some deal, I don't think we've ever talked about. So what's the deal with earnest money with the DST?
In terms of what?
Putting earnest money down on a DST.
You don't have to. You don't have to do that.
Did you hear that?
The DST world is, even though DSTs have been part of the 1031 exchange process now for 23 years, and I think we did about $10 billion in transactions last year industry-wide, so it's very well established and it is a serious component in the 1031 exchange process. It's still very much a niche business, and there are only a handful of brokers such as ourselves that do a large volume in DST. And because of very deep relationships with the property sponsors, if someone sees an offering that they find very compelling, but they're not quite yet closed and in cash, we can always reach out to the property sponsor and ask them if they are willing to hold equity for our client contingent on their closing. And more often than not, they're willing to do that because of our relationships with them, and to the fact that if for whatever reason your sale fails, things go sideways, or at the last minute after additional scrutiny on the product, you find some hair on the dog and decide not to proceed. No harm, no foul, because there's a lineup in back of you of people who want to get in the door from a product standpoint and are precluded from that because every DST program has a finite amount of equity available in it, and once it's fully reserved or subscribed, it's, for all intents and purposes, gone. So if you decide not to move forward with the DST, they're simply going to take that equity and give it to whomever is standing in line in back of you. So you don't have to put earnest money down for DST.
So there's a lot of confusion out there at different times with respect to timing on 1031s, and your clock starts on settlement on these things. It's not with your negotiation. You're putting money down on something. And a lot of times people think, well, gee, I can't make the offer on the replacement. My relinquished hasn't closed. If you make an offer on something or you do something where you need earnest money, you can go ahead and write those offers. Just don't let anything close without it being set up as an exchange. And if you put earnest money down on something, we can reimburse you that earnest money. In this context, we don't need to deal with that. But I just don't want people waiting around for a closing and negotiate purchases and move forward on stuff. You don't have to. Go ahead, talk to the brokers, work in that space, figure out where you're going. the moment you decide to sell something. That's when I'd like people to start looking at things where they want to go. Don't wait until it closes, start looking. Bob made a comment about a sponsor, and this is where it comes down to who you're working with, the brokers that you're working with, and the sponsors. They've got to be people that have been in the business, understand it, and are there to help your transaction go through smoothly. You don't want to be dancing with somebody that's never danced before in this space. So it's really important that not just the brokers you're involved with, but that sponsor is going to be critical. And I would say, back to my comment on preservation of capital earlier, if we look at recessionary times to go through the last crash, we had a half dozen survivors out of 50 or 60 sponsors. Right now we're up to like 60 or 70 sponsors, and I'm just going to throw out there that you're not chasing yields right now. You want to be working with sponsors that have been through these bad times and are prepared to do it. And one of those deadly sins of the DST space is they can't have capital calls. So you've got, once again, if properties are not performing, that sponsor's the one that's going to be dealing with this stuff. And that's yet another reason to deal with people that have been through these things, not somebody that's never seen one. So anything you'd like to add along those lines, or are you good at the moment? And
well, I think that final point was a very, very good point, because everything goes up when interest rates go down, or most things go up when interest rates go down. But when interest rates start going back up, the wire pools for all assets get smaller and prices usually come down. So you don't know who's swimming naked until the tide goes out. And it's been a very, very full flood tide for over a decade now. And it's probably past time for the tide to go out. And that's when integrity, strength, capitalization of your property sponsor and manager is critical. Because if they're undercapitalized, if they're underexperienced, then they may not know what to do in times of crisis, and they simply may not have adequate capitalization from a corporate standpoint to do the things that need to be done. So, as David just mentioned, that's we think that's an increasingly important consideration at this point in time.
Well, Robert, thank you for joining today again. It's always fun to do this with you. For those of you in the audience, if you've got questions on some of this stuff and we're not getting you answers to it, please throw those questions out. The only dumb question is one that's not asked. And we're always looking for content to provide you. So I know that there's people with questions out there. Please don't hesitate to reach out to Seymour, C-M-O-O-R-E, at 1031exchange.com. That's Celia, Seymour at 1031exchange.com. And we're happy to address any questions you may have, or if you've got suggestions for content, please don't hesitate to reach out and let us know. So, Robert, been a pleasure. Thank you very much. Robert Smith, Peregrine Private Capital, and David Moore, Equity Advantage, 1031exchange.com. Thank you for joining us.